The broadcast is now starting. All attendees are in listen-only mode.
Good morning, good afternoon, and good evening, depending where we find you in the TOC world today. For those of you who I have not met, I'm Marcia Hutchinson, the General Manager for the TOCICO, and it is my great pleasure to welcome you here today. Our webinar today is called Back to Basics, TOC. It's around Throughput Accounting and is being presented by Beau, Ganas, and Dr. Lisa Lang. Beau recently joined Science of Business and is a speaker and advisor who has discovered through experience and education that typical accounting practices are leading companies down a destructive path. He rapidly realized how most accounting tools that were intentioned to aid management decisions actually distort reality and stand in the way of making good decisions. A former auditor, controller, and cost accountant extraordinaire, Beau is now the Throughput Accounting guru and seeks to establish Throughput Accounting as the main system of managerial accounting used today. Dr. Lisa Lang is the president of Science of Business and is a renowned theory of constraints expert and is the foremost expert in the world for applying TOC to marketing. As the president of Science of Business, she invented the Mafia Offer Bootcamp, developed over 100 Mafia offers for Fortune 100 companies and other organizations around the globe. Dr. Lisa's Mafia Offers, dealing with the market constraint chapter in the Theory of Constraints Handbook, is #1 spot on the Amazon bestseller list. Dr. Lisa worked with Dr. Goldratt, serving as the Global Marketing Director for Goldratt Consulting, is a PhD in engineering, as a TOCICO Certified Expert, and is currently on the TOCICO Board of Directors. It should be noted that Dr. Lisa's Mafia Offer Bootcamp will be offered at the upcoming TOCICO International Conference, and we encourage you to attend that pre-conference workshop and also the conference. And without further ado, I will turn this over now to Beau and Lisa.
Thanks, Marcia. Hi, everyone. As a member of the board, one of the things we discussed is adding educational webinars that cover the basics of theory of constraints. And for this Throughput Accounting one, I volunteered Beau. He's got all the credentials. He's a CPA, CMA, CFE, CISA, and CIA. Now, he tells me that it's not BCIA, but you know, I'm a little bit skeptical. And not only that, he's also TOCICO certified. So please turn off your phones, step away from your email, and pay attention. This is going to be good. So Beau, over to you.
Thank you, Marcia and Lisa. And CIA is Certified Internal Auditors, not Central Intelligence Agency. So there's no need to cover your webcam. I'm not watching you. Hopefully you're watching the webinar. So with that, let's get going into the Throughput Accounting basics here. Starting out in the early 80s, Dr. Goldratt identified cost accounting as a major issue in organizations. In fact, he labeled cost accounting as the #1 enemy of productivity in a speech he gave at the 1983 National Association of Accountants. This is now known today as the Institute of Management Accountants. And unfortunately for us here today, the accounting industry has not changed much at all since the time Dr. Goldratt gave this initial presentation. So before we move forward and look at Throughput Accounting, I want to begin by looking back and look at the development of cost accounting and its history. So cost accounting is rooted in its early foundations, are basically, from what I've found in research, is the early 1800s. The rail industry and the textile industries were the two first industries to begin development of cost accounting. I think this is due to their being both highly capital intensive without a lot of variable costs, thus the need in the manager's minds at the time to allocate to develop pricing and that type of thing. However, cost accounting really took off when General Motors adopted cost accounting. General Motors is kind of the is what Six Sigma is to Motorola. That is what cost accounting is for General Motors. This is because General Motors, different than Ford, actually had different product lines and introduced the model year change. Thus, there was a high rise in the diversity of products that were offered by General Motors. So instead of just making one Model T, General Motors produced Buicks, GMs, Chevrolets, and a whole host of other vehicles. And within those brands, there were different models. So with that, the need arose, and the question managers were beginning to ask the accounting team was, what are the products with the highest cost? So said another way, where do I focus my cost-cutting efforts? So with that brief background on the history of cost accounting, I want to lay out the many uses of cost here, so that as we go through the presentation, you know what I'm referring to. The word cost, as we use it today, has several different definitions. The first is product cost, which is the operating expense of a product, and that is based on an allocation. The second is the cost to operate, which is the expense required to operate, whether that be a company, a machine, any number of things. The third is the cost to purchase, which is the amount we need to pay in order to acquire an item. And then there's also the cost when selling, which is the price our customers will need to pay to acquire the item from us. So today in the webinar, we're going to refer to cost, and you'll see cost per unit. That is really referring back to product cost, which is the operating expense of a product. And again, this is based on an allocation process. So as cost accounting was developed at the railroads and the textile mills and really pushed at General Motors, the development of cost accounting led to the concept of a cost per unit. Cost per unit, or CPU, as I'll refer to it here in this presentation, has three main components. Those components are direct materials, direct labor, and manufacturing overhead. Most commonly, the cost per unit concept is applied to products. All right. Cost per unit is developed and utilized as if though it represents the true quote-unquote cost the organization incurs to produce a unit. Managers then take this false notion of a cost per unit that is variable and begin to make decisions with it. The fact that CPU represents the true quote-unquote cost is simply not true.
So Beau, why are the costs we consider to be variable, like direct labor, not variable?
So it's a matter of definition, and the traditional cost accounting has defined variable basically as any cost that change. So labor is a cost that certainly can change. We can run overtime and a number of different things. The way we view that from a throughput accounting perspective is that it's not a matter of the cost can change. It's a matter if the costs change on a one-for-one basis with production.
Got it.
So that's the real difference there. So what we want to do now is look at these three components and really understand how they move in relation to unit production. The first being direct materials. Materials are variable with production and on a one-for-one basis. Materials are directly traceable to the products we produce, and we must have a unit of materials to produce a unit of a product or a service. Therefore, direct materials should be associated with the cost to produce a product. So just like a broken clock that's right twice a day, cost accounting got one of the three items correct. So I agree with traditional cost accounting in that direct materials are attributable to a product, should be tracked and traced and attributed to the product. Okay. The next item is the direct labor component. Cost per unit assumes direct labor is variable with a unit of production. Direct labor is in fact arbitrarily allocated to products. And I say arbitrarily, why? Because the reality is that direct labor is not directly tied to unit production in the same way that materials are. Materials move on a one-for-one basis. Direct labor moves in a step function fashion, which is to say we cannot acquire one more unit of labor. Typically, you're going to run overtime or something like that, and you're not going to buy just one unit of labor. You're going to buy several units of labor with that overtime. Therefore, direct labor should not be associated with the cost to produce a product for these reasons.
Yeah, I like that. So to allocate cost, you really do need to make a volume assumption in order to know, how much to allocate. And with the manufacturers I've worked with, that volume assumption is precisely wrong. So the allocations, of course, are going to be wrong. And because assumptions will never be exactly right, cost per unit will never work. And as you point out, the answer is not to try to improve the precision of your allocations, but really to eliminate them. Because I think the danger here is that people think, well, we can just allocate more precisely. Let's spend more time and try to get more precise. But really the message here is that it's never going to be right. And you're always working in history, and instead just eliminate the allocations. Is that a fair summary?
Yes, exactly. And that's exactly the way it's taught. In school, you learn that, all right, well, you take last year's production, you marry that up to your forecast for this year, and now you know what your units of production are for the next year, and that's your allocation base to begin dividing by and calculating cost per unit. The reality is you're never going to get that right. You never can be right. And even if you were right, the notion of a cost per unit is always built on historical information, so it really can't help you make decisions looking ahead with that bad information.
Okay, got it.
The third and final piece of a cost per unit is the overheads. Again, cost per unit allocates overheads to products or services and treats the overheads as variable. Oftentimes, overheads are fixed in the short term. Overheads are typically your rent expense, your managerial salaries, utilities, taxes, those types of things. Overheads may change. You could have a new lease that comes up and your rent expense could go up, but they change in a step function fashion. Overheads are not continuously variable with production as materials are. Therefore, overheads should not be associated with the cost to produce a product for these reasons.
The question that I get asked most, I've given my maximizing profitability speech probably, 500 times. And the most common question is, well, what about overtime? Isn't that variable?
Right. And overtime, it is variable in the sense that it can change. However, the overtime is not variable with the unit of production. So what's happening is, and this is where we as cost accountants have muddied the water around what is variable and not variable. Just because something can vary does not mean it is a variable cost. In throughput accounting, the definition of a variable cost is directly linked to moving with a one-for-one basis with a unit of production. So when you run overtime, typically you're going to run, at least another 4 hours, another shift, something like that. And in that time, you're not doing that for just one unit. There are several units that are going to be producing that overtime, and thus it's not moving one for one with unit production, but rather in that step function fashion, just like overhead.
Okay.
All right. So this leads us to the cost per unit distortion. The allocation process leads managers to believe that bigger is better. The reason why is that as we produce more units, we lower the unit cost. All right. So despite unit cost decreasing, cost in total do not. How can this be? It is due to a mathematical illusion, not as a result of our operating effectiveness. So let's look at an example to really illustrate what I'm talking about with this. Assume company costs a lot, pays $500,000 of direct labor expenses each month. In month one, let's assume the company produces 10,000 units, and in month two, that it produces 20,000 units. Let's calculate the labor cost per unit and total labor cost each month. So here on this chart, I've taken the total labor costs for each month. I show you the units of 10,000 we produced in month one, and then the 20,000 we produced in month two. If you divide the units into the labor, you arrive at the cost of labor per unit, which is $50 in month one and $25 in month two. However, total labor expenses in each of the months are $500,000. All right. So most managers will look at this and go, well, geez, we really need to be producing 20,000 units a month because my labor costs are cut in half. The reality is that we're not cutting labor at all. Labor has remained the same. All right. So the reality is that it's not somehow cheaper to produce our products. We're going to be more profitable because we're generating more margin by selling more units. Not because we're cutting costs at all. We're just going to generate more margin, which is what's going to produce more profit for us. At most times, changes in production do not affect our non-variable costs of direct labor or overheads. Thus, they are not relevant in most of the decisions we're going to make as a manager.
So traditional accounting would say that my cost per unit decreased due to spreading the allocation over more units. But in throughput accounting, we don't calculate the cost per unit. Throughput accounting would say that we've produced more throughput margin with the same people and resources.
Exactly. So it's not a matter of, we didn't somehow cut costs, rather we generated more margin.
Got it.
So to summarize on cost per unit, cost accounting systems distort reality and the decisions made with cost per unit information. Cost accounting systems are easily manipulated. We know this if you've ever looked at public company reporting. One of the easiest ways to manage earnings is to manage the inventory. And all systems are manipulated by this simple rule of where the time goes, so too do the cost. So for instance, if you have a product that takes 2 hours of time to produce in total versus a product that takes 30 minutes, the product that takes 2 hours will carry more quote unquote cost in any cost accounting regime than the product that takes 30 minutes. It doesn't matter if you use activity-based, traditional, absorption, standard costing. If you're allocating, the allocations really follow the time. So the question now is, so if cost accounting is wrong, how can we fix it? Unfortunately, there is no fix. It's not a matter of a more precise allocation. It's not a difference between applying the right method of allocation to your company. It's not activities versus products. None of that is in the direction of the solution. The reality is that allocation equals distortion. Thus, we know the solution must not allocate. So the TOC's approach in throughput accounting, when it was developed, has been rebuilt from the ground up as a completely new solution. We do not allocate, and thus we do not get all of the distortions that an allocation-based method would bring along with it. So to give you a little background on throughput accounting itself, throughput accounting was developed in the early 90s by Dr. Goldratt to address the issues of cost accounting. He explained this in his book, The Haystack Syndrome, and later incorporated throughput accounting into later versions of The Goal, which many of you have probably read. The experiences of implementing TOC at companies would create friction oftentimes with the accounting systems, and it's important to know that because the accounting systems are the measurement systems, and Dr. Goldratt's famous quote of "Tell me how you measure me, and I'll tell you how I behave," really paints a picture of how accounting drives our behaviors in organizations.
Yeah, I can give you one example. In trying to implement drum buffer rope to achieve better flow, we often need to reduce batch sizes. But in cost accounting terms, the bigger the batch, the smaller the unit cost. They spread the setup across more items. So when we want to reduce the batch size, there's oftentimes a lot of resistance. I've got a lot of battle wounds from that.
Oh, yeah. Yeah, and I did it as well as a controller. I tried to argue that we should run the less efficient machines at our organization more to increase throughput. However, I got walloped over the head by the rest of the management team for that suggestion.
Yeah.
So to cover the basics of throughput accounting itself, there are three main components to throughput accounting, those being throughput, which we'll represent with a T, inventory or investment, which is represented with an I, and then operating expenses, which we'll call OE. All other basic financial accounting concepts remain the same. So we still have debits and credits. It's not like we are going to invent a third column called credits. It's still debits and credits. We're calculating depreciation in the same way. We're not really altering any of those mechanics. So it's not the mechanics that are as important so much as the insights that we draw from the different presentation of the accounting information. Okay. So let's dive into each of these three and see how they are defined and how they operate. The first is throughput, which is represented with a T, and throughput is the rate at which the system produces goal units. In business, this is the rate our system produces net new dollars. Now we could say euros, pesos. It's money essentially. So as the rate at which our system is producing new money. Throughput can also be viewed as the value our organizations generate. Okay, and we'll see this here when we mathematically define throughput as revenue less totally variable cost. Essentially, throughput represents the value that our conversion process is adding to the raw materials that go through our system, and that this is essentially what the customers are buying from us, and this is what they value, is the throughput we generate. All right. So the last bullet point there is that throughput can be mathematically defined as revenue less totally variable cost, or TVCs, and this is throughput. So the next question would obviously be, what are TVCs? TVCs are totally or truly variable cost. I believe it began as truly variable cost, and that was because Dr. Goldratt looked at what we as cost accountants had called variable cost and said, you've completely screwed the pooch, you've missed the mark. I am going to call these truly variable costs because I know the true definition of variable cost. Later, I believe it was also changed to be totally variable cost, but basically just a change of words, it means the same thing to us. These are costs that vary totally on a one-for-one basis with production. They can also be thought of as a cost that would be saved if we did not make any products. So if we went to our factory and turned off the lights for a month and said we're not going to produce anything, what are the costs we're going to save? The typical examples are material, outside processing, freight in and freight out, and commissions.
So, Beau, in my experience, the part of throughput accounting that people struggle with the most is that direct labor is not considered a truly variable cost. Why do you think this is so difficult to grasp?
So I think it's the way that we have categorized it in the traditional cost accounting world as labor is variable because we see, we look so granularly at it. We say we pay these workers by the hour, so it varies by the hour. The reality is, in 10 years of auditing a company, I never saw anybody that did not work basically a 40-hour-a-week shift, if not more. And so we're not paying people on a piece rate anymore. So yes, labor can vary by way of overtime, but it does not vary on a one-for-one basis with production. If it did, when the machine broke down, the managers wouldn't run around and kind of freak out because now they're paying people not to produce. They wouldn't have any costs associated with it if the workers weren't producing. So in that way, yes, labor is variable, but it is not tied to production, which is why we do not consider it to be a TVC. The next part of throughput accounting is I. So I has two interchangeable uses. One is inventory, the second being investment. Here we're going to look at just inventory. Inventory is the money the system invests in purchasing things the system intends to sell. So we could say that this is raw material we're buying to sell. It could also be, for a distributor, units we buy of products that we intend to sell on down through the supply chain. Throughput accounting defines inventory in the same basic categories of raw materials, work in process, and finished goods. The distinction is the value given to inventories. Okay. In throughput accounting, inventories are carried at their TVC value. That is their totally variable cost value. Typically, this is just material costs and freight in. Now, if we look at the second use of I, it is investment. So originally, the definition of I was just inventory. However, it expanded over time to be investment as well. And I, in my mind, think of investment when we refer to investment as basically total assets. So suppose a new sales strategy required a company to support more credit sales. Let's say they've been selling all of their production on a cash basis, but now a new customer approaches them and says, hey, I'd like to buy a lot from you, but you've got to float me some money so that I can have some time to pay for this. The company will now be required to invest working capital or cash into accounts receivable to capture this throughput from the sales offer that it has. Okay, so that's an example of how we can use I as investment. When we categorize I as investment, we can also use this to calculate the return on investment for a particular project or initiative. And then the last piece of throughput accounting is operating expenses. Operating expenses are all the money the system spends in turning I into T, or inventory into throughput. Operating expenses are the total expenses other than TVCs that a company has in any period. This would include wages, salaries, depreciation, interest, overheads, basically anything you can think of that is not a TVC. Labor is included here unless it is paid on a piece rate basis. And essentially, throughput accounting treats all costs other than TVCs as a period cost, which is to say that if an organization incurs the cost and pays the cash for it, we will put it on the income statement.
So the only way labor would be considered truly variable is if we paid piece rate. Is there any other circumstance where we would consider labor variable?
There are a couple other instances. So I would say that labor being an operating expense and not a TVC is the rule. However, there are some exceptions that come in the form of certain contracting or subcontracting situations when we bring labor on in that regard. And really, it depends on case by case and at kind of what level we're bringing labor in and how we're paying them as well.
Okay, so if somebody was doing time and materials, it would still, labor would still be considered part of operating expense for our own internal use.
Right.
Okay.
Right. So these are the three basic pieces of throughput accounting, TI and OE. And with just TI and OE, our decisions gain a tremendous amount of clarity. So if we ask ourselves how much investment is required for X initiative, that is I. If we ask ourselves how much operating expense will we really save, we can very clearly define that amount. So for instance, the classic example given in cost accounting is you do a setup reduction effort, you save 2 hours of time, you multiply 2 hours times the number of setups in a year times the employee's labor rate, and you come up with this cost savings number. However, the question I always had was, well, wait a minute. We say we're reducing setup time and saving money and all this. However, we still have the same employee who's still getting paid the same amount. So how can we say we really saved money? So in that example, to save labor, we must actually have fewer people working at the company. Okay, so OE, movements in OE are really clearly defined, and we get rid of a lot of the illusions we have in traditional cost accounting. The second piece is that we realize substantially that all of our products will generate positive throughput. So this is inherently different than traditional cost accounting, which views products as some are winners, some are losers. So instead of asking who are the winners and losers, what we ought to be asking ourselves is the question of which product mix generates the highest level of throughput for our company. Additional insights will come to bear from the paradigm shift with throughput accounting, because throughput accounting reprioritizes TI and OE. Okay, so historically, the three pieces of TI and OE have been prioritized by cost accounting as operating expenses first, then inventories, and finally a distant third of throughput. And the reason for this, we view throughput as, well, I can't force someone to buy. The market sets the price. All I can do as an organization is simply make it available and hope someone buys it at the market rate. So really, throughput is outside of my control. Inventories, I can control a little bit. I can somewhat corral them, but I really can't plan and manage them quite as well as I can OE. So I'm going to put inventories in second place, but operating expenses, we view those as directly controllable. And these are the expenses we sign the checks for. We can go after our vendors to get lower prices. We can do all sorts of things with operating expense. So historically, we viewed operating expense as the critical and main most measure that we had available to tap to increase our profitability. However, throughput accounting flips these priorities completely. Throughput accounting says T is the most important, then I, which is closely related to T, and lastly, and in a distant third place, is operating expense. So if we are flipping these priorities, and if this is true, where do our managers focus today? I would tell you most managers are still focused on OE and ignoring T. And what story are our financial statements telling us? Well, you only have to look at how many line items for expenses we have relative to throughput line items to understand that our financial statements are completely focused on operating expenses instead of throughput. So if we're going to take TI and OE and throughput accounting and begin to make decisions, what do we need to do? We need to begin making decisions utilizing throughput accounting. We only need to know the TI and OE between alternatives. We call this delta TI and OE. So delta TI and OE is an extremely powerful, it's easily understood, and quickly implemented tool to make good decisions. So what we're going to look at next are the basic 5 categories of financial decisions. Those would be company-wide decisions, business unit level decisions, product level decisions, investment decisions, and then make versus buy decisions.
Under which category would decisions to take a job or how much to charge for a job fall?
I would categorize that as a product level decision, Lisa, And although I say product here, we could also substitute the word service. So really product level or service level decisions are those decisions that are kind of focused on how do we generate throughput at the company.
Okay.
All right. So let's begin with company-wide decisions. Company-wide decisions are monitored and measured on our financial statements. It's going to help us answer questions like, are we achieving our goals? If so, why is that occurring? That seems to be a good thing. Let's keep it going. Or if not, what are the obstacles that prevent us from achieving our goals? The financial statements should also answer the question, where should we focus our efforts? You know, if we have a sales problem, we obviously shouldn't be worried about the IT department. We ought to be worried about sales. Financial statements should also help us identify the weak areas that are to be improved. There's just one problem with our financial statements. They don't answer any of these questions.
Aha, I definitely agree. And my question for you is, why do you accountants torture us like this?
Well, if we didn't, we wouldn't have our jobs, right? No, it's because of the development of cost accounting and traditional accounting. We have, as accountants, accepted it at face value, and we've accepted these distortions. It's just kind of a fact of life, and no one's really thought it through and taken the reprioritization of TI and OE to the financials.
Got it.
So the cost accounting, or excuse me, the cost allocation process creates distortions of the actual results of the company. It does this by allocating costs to the inventories. In doing so, the allocation process essentially defers expenses from one period to the next. It's kind of like, having a perpetual credit card. I'm not going to pay it this month, I'm going to pay it next month. The allocation process behind cost accounting methods takes expenses off of the income statement and parks them on the balance sheet until a later period.
That last point is really important. The way I describe this distortion is as follows. When there is a period-to-period change in inventory on the balance sheet, that change will impact the cost of goods sold on the P&L. If there was an increase in inventory, cost of goods sold goes down because they can spread the cost over more items. And if there is a decrease in inventory, cost of goods sold goes up. Can you go really slow on this part and help everyone understand? Maybe give us an example.
Yeah, sure. And this is critical to understand. And I've actually had arguments about this with the former FASB chairman that was at my university, Dennis Beresford, about this very thing. So let's walk through that and let's look at an example or two to see how this really operates in reality. So the first example, we're going to look at two companies that have the same revenues. They also have the same expenses. So their results in reality are identical. They should be giving us the same information, right? However, these two companies report drastically different results. And the question we have is, why is that? How can you have the same reality but report different results? So let's dive into the numbers and look at them. So there are two companies. The first is Inventories R Us. The second is Throughput Accounting, Inc. And we're looking at 2 years of their results, all right? So the first item to note is that in their cost of sales, direct materials, the DM, there's not any difference at all. However, if we were to pull apart their cost of goods sold or cost of sales section and separate it into direct materials and conversion costs, the CC there, that is their direct labor and overhead, or said differently, the two parts of cost accounting that receive allocations, we see that this is where we start to have a lot of difference, okay? So in the cost of sales section, Inventories R Us, who is using cost accounting, reports conversion costs. All right. However, Throughput Accounting does not. That is because they are not totally variable with the product. So we're going to report those expenses down below on the SG&A line, or what we would call operating expenses in Throughput Accounting. Now that leaves us with a different gross margin between Inventories R Us and Throughput Accounting. In Throughput Accounting, we don't use the term gross margin. We would just call this throughput. So the 400 and 600 represent throughput there on Throughput Accounting's income statements. And then we see the difference in the SG&A section. So in a typical model, Inventories R Us would report 200,000 of SG&A, whereas in Throughput Accounting, we're going to report higher operating expenses because of the expenses we pulled out of the conversion costs and put those below. Now, all this results in a net profit being reported that is very different. In year one, Inventories R Us reports $150,000 of net profit, whereas Throughput Accounting only broke even. In year two, Inventories R Us reports $350,000 of net profit, whereas in year two, Throughput Accounting Inc. only reported $100,000 of net profit. So the question is, where are these differences in net profit going? So we have $150,000 of difference in the first year and $250,000 in the second year. So to really find where these costs are going, we have to look at the balance sheet. So if we go to the balance sheet for Inventories R Us and Throughput Accounting, we'll see the conversion cost that Inventories R Us took off of its income statement and placed on its balance sheet. So the conversion cost of $150,000, instead of putting those on the income statement in year one, Inventories R Us actually pulled them off and put them on the balance sheet. That explains the first year's difference of $150,000. Now the second year, if you recall, we had a $250,000 difference. So where are those costs at? Because if we look at the balance sheet, we see $400,000, not $250,000. The reality is here, what's happening is Inventories R Us simply added the $250,000 of deferred costs in year two to the $150,000 of deferred costs in year one to arrive at a total of $400,000 of costs that were deferred in year two. So the difference between year one and year two here is the deferral of expenses from year two. Now, if we look at Throughput Accounting Inc.'s balance sheet, we see that, yes, we still have raw materials, just like Inventories R Us has. However, we have no conversion costs that we have parked on our balance sheet because we've expensed all these expenses as they were incurred. Now, one of the things we could look at on the income statement there is to say, well, does this mean that cost accounting actually reports higher net income for us in all periods? No, that's not the case. We'll see that here in example 2. What's actually happening, though, is cost accounting is highly tied to the movement in inventory. So let's take a look at example 2, and we'll see what happens when inventories are not building, but rather decrease, and what impact that has on our financials. So again, these are the profit and loss statements for Inventories R Us and Throughput Accounting Inc. for years 2 and 3. So in year 2, we had the same set of numbers of $350,000 of net profit for Inventories R Us, while Throughput Accounting only reported $100,000. However, in year 3, the net profit for Inventories R Us it's actually not net profit, it's a net loss of $180,000. However, in year 3, Throughput Accounting reported a $120,000 net profit. So remember back to the original assumptions. These are the same companies with the same results, yet we're getting different answers on our profit and loss statements. So how could this have happened in year 3? Well, again, we've got to go back to the balance sheet to see the answer. In year 3, what happened is that inventories decreased. Now, this could be for any number of reasons. It could be because we implemented lean or we implemented TOC and we saw significant drop in inventories. It could also be because there was high demand that just literally pulled the inventories off the shelf and we were not able to replenish those inventories fast enough. So in between years 2 and 3, our conversion costs on the balance sheet dropped $300,000. That's huge. So when those inventories dropped, these conversion costs of prior periods were actually put onto the income statement in this period. And that's why we see the difference in net profit of the $120,000 to the $180,000, that difference in year 3 on the P&Ls. Okay. So the allocation of expenses to the balance sheet each period distorts our results that we're going to report. Whether or not cost accounting or throughput accounting reports higher or lower earnings actually depends on the changes in the inventory levels. When inventories rise, cost accounting reports higher profits. However, when inventories drop, cost accounting reports lower profits. So this is one of the conflicts that most public company managers face, is that in order to maximize their profits that they report to shareholders, they must always be growing inventories. However, we know now today from whether it's lean, JIT, TOC, any number of improvement initiatives, inventories are one of the main blocking factors that prevent us from improving. And we always strive to lower and decrease inventories to the extent possible. So this distortion through allocation means managers cannot really determine the real actions or the results of their actions, and that they're in an inherent conflict between cutting inventories on one hand, but also reporting the highest results on the other.
So they're reporting these higher profits, but they're not real. It's that distortion you're talking about, and they're doing it through the interaction between the P&L and balance sheet and cost of goods sold. Is that correct?
Yes, exactly. And so what's happening is they're manipulating their cost of goods sold section year in and year out to kind of massage and manage the numbers to report the earnings per share that the shareholders and the analysts are expecting them to report.
Okay, got it.
All right. So the next piece of our big five would be business unit decisions. So as companies grow in scope and complexity, different lines of operation may develop, just like General Motors. They acquired several different car companies, which ultimately became brands. And within brands, they had different models. So the question of how our business units are performing then arises. Often to assess this, we take out, when we have a shared company with different business units, we often have what's called a shared services group, which would be accounting, HR, IT, and these are our corporate overhead expenses. These corporate overheads are then allocated to the business units, okay? Now, they can be allocated any number of ways. They can be allocated based on revenue or gross margin. They could be a time-based allocation. So where do our managers spend most of their time? What are they focused on? It could be also evenly allocated. We could say we have 3 business units. We're going to take overhead, divide by 3, and evenly apply it. Or we can apply it on an activity-based level allocation. However, no matter how we do it, we're still creating a distortion. The allocation of corporate overheads distorts the reported performance of the business units. These are not costs that are controlled by the business units, and they have no authority to cut these costs. So if I'm managing, let's say, the Chevrolet brand for GM, and I receive an allocation of IT costs from corporate, well, it's not my IT cost. I didn't make any of the decisions about IT, yet I'm being held accountable for these costs that I do not control. The allocation methods are arbitrary and subjective, and because of that, this leads to massive infighting among the heads of business units, because essentially we're talking about in one stroke of the pen, we can determine whether or not someone gets a bonus or not for that year.
Yeah, I can't tell you how many times I've seen these fights in my time in corporate America. This allocation of corporate overhead can determine a business unit's profits and whether or not I'm getting a bonus or somebody in another business unit is getting a bonus. And these are some of the most intense fights that I think I've seen in corporate America.
Right. Well, and I can imagine so. I mean, I would fight tooth and nail for my bonus. And so, the net result is I want to push all the allocation to your department, not to mine. A second way cost allocation affects business units is through transfer prices. So the cost accountants develop our product costs of the products that are made in, let's say, business unit 1 that are then used by business unit 2. So let's say business unit 1 produces a raw material for business unit 2's process. And once this calculation is made, we basically draw straws and begin to fight. So the reason for that is because depending on where we put the transfer price, that is ultimately going to determine who benefits the most or who is hurt the most by the transfer price. So then we begin to ask questions like, should business unit 1 or business unit 2's manager decide the profit margin on the product? All right. So the reason for that is this. Business unit 2, his manager may say, look, I can go buy this product cheaper from the outside, so you've got to cut your product margin, business unit 1. However, conversely, business unit 1 could also say, well, I can sell this product externally for a higher margin than what my business unit 2 manager is willing to pay me. So what we find is that if business unit 1 has priced the product too high for business unit 2, should we allow business unit 2 to go outside and buy the same raw material from a cheaper, although third-party supplier? And what if business unit 2 is not willing to pay for business unit 1's product at the transfer price? Should we allow business unit 1 to go out and sell the product to external parties? The end result of all these decisions is that all of the efforts of the managers are directed to optimizing each one of the business units instead of the company as a whole. And so what you find is that people will actually not buy something, quote unquote, internally that would cost less to produce. They actually go spend more money to produce it outside because it helps their business unit appear to have higher operating results. So we're going to look now at the third category, which is product level decisions. You could also substitute service into, it could be service level decisions as well. Cost accounting's predominant driver in product level decisions is the cost per unit. As we discussed, there are numerous significant flaws in the concept of cost per unit. In throughput accounting, the focus is on generating throughput, not on saving cost. And as I said earlier, the priority system is rearranged and the focus and nature of decisions is greatly changed. So the allocation process creates the flawed cost per unit concept, which distorts product profit margin. And as a result, our product mixes are wrong. So at almost every company today, the need exists to go back and to reevaluate our product mixes from a throughput-based perspective, not a traditional cost accounting and product profit perspective. The reality is that almost all of our products generate throughput, which is a positive value. So there are no winners and losers. And product mix changes can have a significant short-term positive impact on our profitability.
Agreed. Every product sale generates throughput regardless of how much time it takes, unless you have to scrap it so many times that the raw material is equal to or greater than the sales price. But unless that's happening, that you're producing bad stuff and you have to keep buying the raw material, you are generating positive throughput on every sale.
Exactly. And if you burn through so much raw material that you have a negative throughput value,
yeah, you got bigger problems.
Exactly. So let's take a look at an example of this so we can see how this really impacts and what the impact of cost accounting is. A company has two products, P and Q, and below is a summary of the products from a cost accounting perspective. They have the selling price, we have the raw materials, the direct labor, and the overhead for each one of the products, and then we have the traditional product profit. So from above, if we had a choice to pick from these two units, we would obviously want to maximize the production of product Q. That's what cost accounting would tell us. It's got the highest product profit. Surely maximizing Q will generate the most amount of profit for our company. So below is the production capability for 1 week of these two products. This came from our production manager who told us this is what he can do given the two product mixes we have available to us. And you can only pick one of the following mixes. So if I'm going to use the cost accounting mindset, I would pick, let's maximize Q, and then I'm going to fill in the rest of the time with product P. However, throughput accounting approaches this a little bit differently, and we say we must calculate the difference between the alternatives by using delta T, I, and OE. So let's do that. And before we get to the calculations, let's ask ourselves a few questions. What would cost accounting suggest our product mix be? Well, I think I've answered that. It should be product Q based on cost accounting. Cost accounting is going to suggest that since it has the highest product profit. So let's now compare the two and see if that is actually the reality. So when we maximize Q, this is the calculation for the P's that are produced and the Q's that are produced to calculate their throughput. It results in generating $5,700 of throughput. However, if we look at the other alternative, which is to maximize P, we see that we're able to generate a throughput of $6,300. So if we were to put these two in a summary format, we see this. This is what the delta T, I, and OE looks like. And so the result is that if we maximize Q, we actually will generate $600 less of throughput than had we maximized P. So throughput accounting would say this. There's an obvious answer here. We want to maximize the production of P, not Q. So this is just one example of how when we take a scenario and view it from a throughput accounting perspective, we get a wildly and totally different answer than what cost accounting would suggest. And this is the P and Q problem from the haystack syndrome. And what we find in that problem is that this actually ends up resulting in the difference between making money or losing money in our company. So this is a critical example that we need to understand and better apply in day-to-day management. let's move on to the inventory or investment decisions that we have. Traditional cost accounting systems rely upon cost savings to determine return on investment, or ROI, the payback period, and are used as justification for investments. An acceptable payback period can range from 5 to 10 years. An ROI above 10% is just considered to be outstanding for most investments that are used when cost savings are used as justification. Investing from a throughput accounting perspective takes an entirely different approach. A payback period of 2 years would likely be unacceptable, and ROI below 20% would likely be unacceptable as well.
How is that throughput accounting's expectation are so much different than cost accounting's?
So that really goes back to the prioritization of TI and OE. And so with throughput being the main focus in throughput accounting, there's so much more leverage to be gained when we invest from a throughput perspective that we can generate significantly higher returns. So that's why we have shorter payback periods and much higher returns.
Okay.
So let's check out two examples. We're going to look at one example for inventories and then one example from an investment perspective. So the inventory example, our company could sell all of the P and Qs from the previous problem if we held $20,000 more in inventory. However, we also need to hire a worker that would cost us $19,200 annually to manage these new inventories. Our company's hurdle rate is 20% annual return on investment, and there are 48 working weeks in our year. Assuming we pick the maximized P product mix because we're using throughput accounting, should we, in this scenario, hold the higher inventories? So what we're going to do is we're going to calculate the additional throughput we can generate. So we see that each week we can generate $1,200 of additional throughput if we sold the remaining 20 units of Q that we could not produce previously. And in our year, there are 48 working weeks. Thus, we're able to generate $57,600 for each year that we take on this initiative. However, we had to hire the new worker, which cost us $19,200. So if we put that in our Delta T, I, and OE format, we see that we will generate an additional $36,400 of net profit, and all it took was $20,000 of an investment in our inventories to generate this new net profit. That results in an ROI of 182%, which is just through the roof. So yes, obviously, we should hold the higher inventories. It will increase our bottom line by $36,000 approximately, and the project has a 182% ROI. I mean, there's no manager in the world that would turn down this initiative. So let's switch gears a little bit and look at I from the investment perspective. Let's say our company could sell all the P's and Q's if we sold to customers on credit. This would require our accounts receivable balance to grow by $30,000 because we need to invest working capital to support these credit sales. And also, because we're having more credit sales, we're going to incur more bad debt expense. That bad debt expense will increase by $24,000 each year. Let's again assume that there are 48 working weeks in our year, and our hurdle rate is 20% for an annual ROI. Assuming again that we picked from the previous example the maximized P product mix, should we sell the items on credit terms? Well, if we do this, we're able to sell an additional 20 units of product P, and we see the resultant weekly throughput. That multiplied by 48 weeks in the year again gives us the same $57,600 of additional throughput each year. However, let's take it and look at it from the Delta TIOE perspective, which says this. Yes, we generate $57,600 of additional T. However, our bad debts rise every year by the amount of $24,000. So we only are going to benefit $23,600. However, it took $20,000 of additional accounts receivable to finance this initiative. So that results in an ROI of 118%. So yes, we should still sell on credit. It's going to increase our bottom line by $23,000, and our project also has the annual ROI of 118%, which is much higher, almost 6 times higher than our requirement of 20%. So now we're going to look at the make versus buy decisions. So the same impact that transfer pricing has on business units is felt in the make versus buy decisions. The reason is that cost accounting allocations create a product cost, which is overinflated and overburdens components for products which have costs that have been arbitrarily assigned. So in the same way that transfer pricing creates these illusions and creates all these arguments, the same thing happens with the make versus buy decision. So let's look at an example to see how this operates. The following shows a comparison between a product produced inside and a vendor's quote for the product. The question is this: should our company make or buy the product? The company needs 10,000 units of part 507. So cost accounting is the first column there that shows that the cost is $150. That's because we have materials of $35 and we allocated $60 of labor as well as $55 of overhead. So if we add those up, cost accounting would tell us that it takes $150 to produce the unit internally. However, the vendor says that he can produce this part for $87.67. So if we were to look at this from a cost accounting perspective, it's obvious we should go buy the product, right? It's cheaper than making it internally. However, let's look at it from a delta T and IOE perspective and see what that results in. So to do this, we're going to do the calculation. So from a throughput perspective, we're really interested in what is the difference in the totally variable cost. The only totally variable cost was the material, which was $35 a unit if we make it. However, if we buy it, we're actually going to have to pay out $87.67. This extended by the units we need results in making the product causing us to outlay $350,000 of cash, whereas if we buy it, we'll outlay $876,000 of cash. Very different results. So to put this in our delta T and IOE model, we see that the change in net profit, if we were to make the product, would generate $526,000 additional throughput if we made it versus buying the product, okay? So we should definitely make this product internally. It will increase our throughput and our bottom line by $526,000 as compared to purchasing the part from the vendor.
Yeah, it takes less cash, but in my experience, I don't see financial managers using that to make the decision. I think what you had 2 slides back is really what they use. They look at the cost. I can actually buy it cheaper than what it would cost me to make it, and that's how they make the decision. Did you have the same experience?
Yes, I did. And that is one of the false notions of the cost per unit. It is sold to managers as being the actual cost to produce a unit. And I'll never forget, I had one company that they were just in startup mode, and when they had their costs fully absorbed, one of the components cost significantly more to make internally than what they could buy it from externally. And the controller was trying to reconcile it back to the CEO and say, look, if we buy it, we're going to lose less money. Or excuse me, we're going to lose more money than if we just made it internally. And the CEO is just scratching his head going, how is this possible when it costs more to make it than it does to buy it? Mm-hmm. So that is really speaking to the fact that cost per unit is portrayed as a totally variable cost to a product, when in reality, it contains so many allocated costs and figures that it distorts that decision.
Yeah.
All right. So let's summarize and look at decision making from a throughput accounting perspective. So unique to throughput accounting is that decisions are linked between global and local. All right. So only throughput accounting has the ability to tie a local decision to the global well-being of the company. We do this by looking at T, I, and OE to make decisions. And what we're essentially doing is recasting our financial statements with T, I, and OE. This is also going to help us create alignment between the various levels of an organization. And this can be achieved by marrying these local actions to global outcomes. So again, what we're doing is essentially creating one version of the truth from a financial perspective, and we're giving everyone the same tool set and the same way to evaluate decisions. So we're going to reduce the local optima phenomena. We're going to reduce the infighting between business units. All those things are going to go away because we've created alignment in our decision making. So how does TI and OE, or throughput accounting, compare to other methods? Well, in my opinion, there truly is no comparison. All of the other methods of cost accounting that are out there are tinkering with product costs, which we know now simply just do not exist. The other methods create a distortion of reality, as they are also built on some form of allocation. So it's not, like I said earlier, it's not a matter of how you allocate. It's not a precision issue. You can't take it out 6 decimal points and get a better or more correct answer. The fact that you're allocating means you're creating distortions, which renders basically the information you generate useless. The other methods, whether that's lean accounting or activity-based accounting, are focused on more precision or simply rearranging the allocation calculation. So lean may allocate over value streams instead of individual products. However, that allocation process still creates the distortion. So it's not a matter of what's being allocated or how it's done. It's simply a matter of common sense. If making a go ahead, Lisa.
I was just going to say that means that activity-based costing, earned value, standard costing, lean accounting, all those other allocation methods suffer really from this distortion. Have you found anything besides throughput accounting that doesn't suffer from this distortion? Is there anything else out there besides throughput accounting?
No. All the other methods are seeking to allocate in some shape, form, or fashion. Activity-based costing, in its theoretical model, as it was published out of Harvard, actually gave some recognition to the fact that some costs should not be allocated. However, it then it said that on one hand, but in the other hand, it actually took some more costs and allocated them differently. And actually, in reality, what I find with activity-based costing is that managers have now simply just created a much more complicated cost accounting system and are allocating everything over multiple cost drivers. So you end up with a system that is not only just as bad and just as distorted, but it costs a heck of a lot more and consumes a lot more time of your financial people to implement and utilize.
Takes a lot more time to be more wrong.
Exactly. So with this, the basic premise here is that allocation will always create a distortion in reality. So any method built on allocation is flawed, and we ought not use it. And throughput accounting is the only method that I know of that does not allocate and thus does not create distortion. If we look ahead for throughput accounting, I think there are additional applications for it. I think there are new categories of decisions, those being strategic, tactical decisions, and also financing decisions. We can also apply and need to extend throughput accounting to budgets and projections. I also think that throughput accounting could be applied to external financial reporting. So currently there's generally accepted accounting principles in the US or international financial reporting standards that are used worldwide. I really think those could be supplanted by throughput accounting, because throughput accounting, in my opinion, actually achieves the aims that those two methods try to achieve, but they don't. And also, we need to take throughput accounting to the ERP systems. All the reports are built on cost accounting. All of the decision and rules inside of ERP are built on cost accounting. And I think we need to shift that to a throughput perspective.
So we've got a question in the chat box I thought was interesting. So if throughput accounting is so powerful, why is it not accepted and used by all organizations? What's limiting it?
Well, so I'll recount a story of my college days. We actually talked about throughput accounting, and the professor gave it basically a 2-second mention. She told us throughput accounting doesn't allocate costs, no one uses it, and it's not on the CPA exam, so you don't have to worry about it. And so I think it's several things that contribute to the use of throughput accounting. First is that there's a link in most people's mind between labor and products, and also overheads and products. You know, the whole reason why we bought this building is so that we could produce these products. So this building must be tied to these products somehow, some way. And managers are seeking to find that way through the allocation. I also think that we have failed to recognize how costs behave in reality. So we have skewed the lines and really messed up what is a variable cost versus not a variable cost. And so for these reasons, throughput accounting has not had wide adoption. It flies in the face of all traditional accounting management. And you know, one of the first questions you get is, as we've discussed with labor, is what the manager will look you in the eye and say, so you mean to tell me my labor aren't working on the products. It's no, it's not that. It's just that they're not tied to it one for one. So there's some finer nuances to throughput accounting that really create some obstacles for its adoption. And also, most public companies, or excuse me, all public companies in the U.S. especially, are forced by GAAP and also by the Internal Revenue Service to report their figures on a cost accounting basis. So if you have so many external requirements to produce allocated information, the starting point for running the company is, all right, we got to produce this stuff, so let's go ahead and set up our system to be able to do that. But no one has taken it to the next step and said, is there a way that I could actually report externally and be compliant and yet still make internal decisions with throughput accounting? It's possible. It takes a little bit of conversion, but you can get the results are so much better on throughput accounting versus cost accounting.
So to summarize, you're saying that if we have to report in GAAP, which is not throughput accounting, it's cost accounting based, and CPAs are not being tested on it, it's really hard for it to get traction.
Exactly. It just is not forefront in people's mind. And try telling a 21-year-old college student that, hey, you need to go learn this new method of accounting that you're not going to be tested on. I mean, it's just not going to happen for the most part.
Okay, got it.
Okay.
All right. Well, thank you, Beau. That was fantastic. We've got some questions in here, and I think Marcia's going to read them out. If you want, Marcia, I can go ahead and read out these questions while I'm here. So let me ask you some of the questions that I see. The first one is,
go ahead, that's fine.
Okay, how would you apply TOC accounting principles for operating an IT group?
For operating an IT group. Okay.
Yeah, I think that's the case where they probably don't have like a lot of raw materials unless they're, buying servers and stuff like that. So there's less, in service companies, there's either no truly variable cost or it's just whatever servers and computers they're buying and putting in.
Yeah, exactly. So the first way is, is to take and ask for any implementation of an IT that you're doing, that you're applying to your company. What is the throughput I'm generating from this? So oftentimes I see technology groups do technology for technology's sake. It's kind of like doing improvement for improvement's sake and not looking at the bottom line. So as a result of any technology initiative, we need to ask ourselves, why are we doing this? Are we going to generate throughput? Or are we going to cut operating expenses? Or can we reduce our investment in IT? And so marrying any decision coming out of the IT group to TI and OE will ultimately marry the decisions and link those to your financials and the performance of the company.
Got it. All right, so there's another one here. How do we arrive at product cost in the case of transfer pricing?
Okay, so it's the same basic way. So what happens in transfer pricing is a company accumulates the material cost. They accumulate all the time spent producing the product. They multiply that by the hourly rate of the workers that are working on the products. And then they use some form of allocation to split the overhead and assign it to the product. They add all three of those up, and that becomes the quote-unquote product cost. And the transfer price is set in any number of different ways. One, there could be a margin that we apply to the product cost. Another way is that they could say, all right, this is our internal product cost. However, what could we purchase this product at from an external party? And then that becomes the transfer price. And the margin there would, any difference between product cost and margin from the third party or the external price would be attributed to the first business unit that actually produces the product. So those are the most common ways I see the price set.
Okay, and then we've got some questions about the recording. People want to know if this was recorded. It is being recorded, and you'll get an email when the recording's available. So look for an email from TOCICO, and they'll let you know when the recording is available. So we got several on that. And then, okay, so how do we explain this approach in terms of this is something accountants already know?
So a couple ways. The first is that any accountant that begins to make decisions with product cost immediately recognizes the flaws. So for instance, let's say we had a product cost of $100 and $30 of that is depreciation. Well, the accountant knows that if someone comes in and offers, the price of, I'll buy this product from you for $80, the cost accountant would typically say, we need to take that on because $30 of this quote unquote product cost is depreciation. It's not going to change and it won't go away. And I can have incremental throughput if I sold this product at $80. But the reality is that most managers and sales folks would look at the product cost and go, you're crazy. It costs us $100 to make and you want to sell it for $80. There's no way I would accept that.
Yeah, the accountants are the ones that get it.
Exactly.
Eventually, I've had accountants in my maximizing profitability speeches, and they're the ones that usually once they see it, they get it, they accept it. I would say 95% of the time. And the people who are resisting more are the operations managers.
Exactly. And, the only thing that's kind of comparable to throughput accounting is what we would call variable costing. However, variable costing still allocates labor to products, which is its big distortion. And it also, it just doesn't look at on the system as a whole. It still looks at things in a very isolated manner. So
yeah,
there's really nothing comparable to it.
Okay, we've got another one here from Joe, and you've got some comments about excellent and thank you for the presentation. But here's another question from Joe. Is there enough information provided in the financial statements provided by companies to do an independent evaluation of the company using throughput accounting?
So as it stands right now, that information is extremely difficult to get a hold of. And the reason is inventories are reported by their category of type. So for instance, it's going to report raw materials, WIP, and finished goods. However, they do not report the allocated labor and overhead in each of those categories. So yes, I might be able to identify the WIP, but I may not be able to identify the direct labor or the overhead that has been allocated to WIP based on the reporting that is currently done.
But to give Joe a little glimmer of hope, there is a way, and one of the things, the reason why Beau joined Science of Business is that we are actually looking at going into companies, helping them extract the information out of their ERP and then look at the data the right way. And so it is possible to get to it. It's hard to do it from just your current financial statements, but you can get to it if you go back to the data and pull it out and look at it the right way. Do you agree?
Yeah, totally. I mean, the information's there, but I would say it's hidden. The ERPs have this information. Now, some of the ERPs are structured in a way that really make it difficult to get a hold of, but most of the times with some work on the reporting systems that are in the ERP, you can get at this information. And once you do, you really start to unlock the power of throughput accounting. Yeah,
and even better if, one of the other things we're doing is we're looking at going in and changing their ERP, like changing their statements in their ERP. They'll still have the statements to do reporting, but what if the things that they regularly printed out of their ERP and looked at were throughput accounting statements?
Exactly.
Even better.
Right, and that's what we're able to unlock for them. And so you kind of have the best of both worlds in that scenario. You've got your cost accounting statements that get reported to the bank or to your tax advisor, but yet for internal decision making, you get the benefit of throughput accounting.
Yeah. Okay, Steve said it would be really useful to have the tables from the examples to go back and study. Steve, we will be providing a PDF to TOCICO, so when you get the email that the webinar is ready to review the replay, there will also be a PDF there. You can download it. I did see a couple typo things that we need to correct, so we'll go in and update that, and then Marcia will send out an email, and you'll have both the webinar as well as the PDF.
Yeah.
Okay, I think it should be pointed out that in the example make versus buy, there was an unstated assumption that we have the capacity to produce all of P, i.e. that no further investment is needed.
Right.
Yeah.
Yes.
I think that's a fair assumption. When selling on credit, when is the revenue and throughput recognized? In the month that the product was sold or in the month the money is received? And I assume this is for throughput accounting. So in throughput accounting, when you sell on credit, when is the revenue recognized?
So going back to the pure theoretical definition of throughput, it would be when you actually get paid on the product. So that would be throughput accounting starts to approach cash basis accounting in that regard. So when you sell on credit, the actual day that you transfer the product in legal right of title, that's when you record it on an accrual or typical cost accounting fashion. However, in throughput accounting, I would say let's defer that until you actually get paid the cash.
Yeah. Okay. In the case of business professional services, do you price your professional services by consulting hour cost? And is hourly cost of service wrong?
So, the way I'll speak from my experience in public accounting, we price it on the hour, which was based on a cost per hour. So they would, as an associate, they would take my salary, they'd take my benefits, divide by the 1 million hours a year I worked, and arrive at the cost per hour, and then they would mark that up, 30 or 50%, and that would be my charge hour. So that model is flawed, and there's a lot of reasons for that. Again, it's assuming that the labor is variable with the unit of production, which it's not, and you still have the end result of all these distortions accumulating through your pricing process as a result.
Yeah, I think for the way that I charge for consulting is more based on the value that I deliver, not some allocation of my time plus a markup. I try to look at, well, what value is this going to bring to the customer, and try to charge based on that value. At least from a consulting standpoint, that's what I try to do.
Right.
All right. How could we apply throughput accounting if we do services against an annual fee? And if we put a fixed contribution margin on each hour that would be accounted against this contractor fee?
So can you clarify that or read that again for me, Lisa, just so I have a little bit more clarity?
How do we apply throughput accounting if we do services against an annual fee or contract? And if we put a fixed contribution margin on each hour that will be counted against it. So it's like almost like a prepaid. They've prepaid, $10,000, and now every time we do some work, we're applying applying a fixed amount that we're saying we're using some of that money that they prepaid, something like that.
Right. I got you. Okay. So throughput accounting would say that there are no costs that are totally variable with that contract if it's a service. And most services do not have totally variable costs, which really puts you, in a weird place, because so many of our pricing models are built on the fact that, okay, we accumulate these hours, we accumulate this cost, and then I compare that to the revenue and say, all right, this is a good job or a bad job to have. The nature of the game here is to say, all right, well, you really got to marry it up to how much you can do, and then say, if this $10,000 is for a year, we know that generates positive throughput. The real question is, how can I generate more than that $10,000 of throughput in a year? Which is to say, can I do this with less resourcing, less time? Can I take on another similar job also in addition to that? So throughput accounting in that regard is a completely different break and model than saying, all right, this is the accumulation of the resource, accumulation of the time, and then the resultant net profit off of this job.
Are you saying that to defer revenue recognition?
To defer?
Yeah, Charlene made a comment here. No, don't defer revenue recognition until account received is collected. This would be a can of worms there's no need to open.
Okay.
Maybe, and that could have been to the previous.
Right. The question there on whether or not when to recognize it on the accrual.
Yeah.
So I see the way I read the throughput definition is actually when we're going to exchange cash. And quite frankly, that is kind of a timing difference between accrual or cash when you recognize it. I don't know that really it creates a big distinction in my mind, but I would prefer to see it on a cash.
You could do throughput accounting on an accrual basis or a cash basis, either one. Is that correct?
Yes, you can.
Yeah, I like the cash basis because to me, you get to the real. It just makes it clearer. I'm not an accountant, and it just makes it easier for me to look at. But most companies do accrual.
Right, and you certainly can. In the applications I've seen, this gets rid of one of the big distortions that most folks have with accounting, is that they feel like they had a great month, yet their financials say they had a terrible month. is all related to that cash versus accrual. So yes, you can certainly use it on an accrual basis, but typically we're applying it on a cash basis just to give folks more clarity.
Okay, and then there's one in here about depreciation. Should depreciation on machinery be considered as OE?
Yes. So depreciation, I can think of one little wrinkle in that there is a method of depreciation called unit of production. Again, back to our assumptions about volume and the capacity of that machine, the unit of production depreciation method would seem to suggest that you could make depreciation a totally variable cost. However, I would say that that is still an allocation type decision because you're really looking into the future and saying how many units of production can I get out of this machine, and the reality of the situation is you're never going to be correct on that, and really depreciation is really more a function of time versus absolute production. So I would still say depreciation should remain an operating expense, not a totally variable cost.
Okay, I think that's the last question I show. Can you go to the next slide, Beau?
Yeah.
Actually, before you do, I just want to point out on here at the top that link to go to Throughput Accounting. Beau's doing a series on Throughput Accounting 101. So if you want more information following this webinar, there's going to be a series there that he's doing. You can also sign up to get a weekly email to be reminded that there's a new post there, but that's just going to be one long series on Throughput Accounting 101. And then the next thing, Beau, if you can go to the next slide, let everybody know that we're doing a Mafia Offer Boot Camp at the pre-conference on April 29th in Vegas. So that's part of the pre-conference day. And then the 2-day conference is April 30th and May 1st. So if you have not registered yet, now is a great time. The boot camp is normally we do over 2.5 days and it's a $15,000 boot camp. Well, you're going to get to develop your Mafia offer in 1 day. And it's a great value. So if you're interested in Mafia offers at all, it's a great opportunity there. Marcia, anything else to remind the audience of or anything we need to go over?
Yes, we have more upcoming webinars, many more. Please make sure to check them out. We have the next in this series for our free series is the Pillars of TOC. It's the foundations that shape all of TOC, and that will be on March 28th. Prior to that, we've got Alan Barnard delivering a webinar on the critical importance of dynamic simulation modeling in management, decision making, and education. And we've got key leverage points to become high reliability in an organization. This is by Baha Inozu. And then a master class in April presented by Sanjeev Gupta, and it's about project portfolio management and scheduling. And so that'll be 3 weekends long, and that's available in April. And just a little more on the conference. This is a really fantastic lineup we have for the conference this year. Our first day of the conference is all about results, where we have presentations from companies like Hitachi on the enterprise-wide TOC implementation. We've got Kevin Coles is going to come in and talk about 30 years of success, TOC and throughput improvement at General Motors. That's going to be a fantastic one. We have creating a viable future in the UK steel industry, so that's another one. And many, many different presentations there, and all of them are about fantastic results. The second day is a wide variety from going from core conflicts and bipolar disorder, mental health care, getting a competitive edge through sufficiency, just many, many really excellent. The rising importance of TOC by Sanjeev Gupta. And also there are some special tracks on technology implementations, and there are companies that are coming in and presenting their actual TOC software technology in the areas of supply chain and project management. So it's a really packed conference this year with really exceptional presentations. And then the day before, as Lisa mentioned, there are some pre-conference workshops. We have them in healthcare, basics in project management. We've got executing project management and how you can actually experiencing it yourself. Re-engineering sales. We've got a demand-driven workshop on the strategy of flow. We've just got some fantastic stuff. The Odyssey program by Alan Barnard, that's a full day session. And again, Lisa's Mafia Offer Boot Camp. So if you have not checked it out or if you have not signed up, please do so. And we hope to see you there.
Thanks, everybody.
Thank you, everybody.
Thank you all.
See you later.